We have seen quite a bit of dollar strength since mid-July. In fact, the dollar index has been rising for a 10th consecutive week and has just made fresh high for 2023. Rates at risk of going higher for longer, relative US growth resilience, and hawkish Fed are factors that may continue to underpin the support for the dollar in the interim. To take stock, recent FOMC in September was a hawkish outcome. Not only did Fed maintain optionality, keeping the doors open for another hike this year, Fed officials also reduced the size of projected cut in 2024 to 50 BP. Economic assessment was also upgraded to solid from moderate. Fed Chair Powell also shared that Fed is still trying to find the right peak level at which to sit for a while. The case of rates staying higher for longer alongside higher food and oil prices can result in a deterioration of global growth inflation mix. This can undermine risk appetite and weigh on Asian currencies, especially those that are highly sensitive to rising oil prices and interest rates, including the Japanese yen, the Korean won, and the Thai baht. We may have to be a bit more patient on the point of dollar inflection, as peak rate uncertainty remains and a dovish pivot is yet in sight. But what is perhaps reassuring is that Powell did acknowledge that rates will need to fall in the future to keep real rates at an appropriate level, but it is just not something that the Fed is looking at it right now. Yes, indeed, the door remains open for another hike, but we believe that the Fed may be done with tightening for current cycle, as inflation pressure is already coming off alongside inflation expectations, and that real rates at 2% is already restrictive. And we reckon that the hurdle for Fed to tighten again in November or December will be high unless incoming data shows a sharp reacceleration in core inflation and job gains pick up again. On net, we acknowledge that dollar strength may still be a dominant play unless a dovish pivot comes into sight. The point of dollar inflection will come when market narrative shifts into trading the expectations for more rate cuts in 2024, and this is highly dependent on how data pans out. So a more entrenched disinflation trend and a more material easing of labour market tightness activity data should bring about the shift and for the dollar to trade softer. The Sing dollar has traded mixed this year, with strength seen versus the Japanese yen and the Korean won, as well as some ASEAN peers such as the ringgit and the baht, while Sing weakness was pronounced against gold and dollar, just to name a few. Singapore dollar's low beta to market events and still hawkish policy guidance from MAS are some factors supporting the Sing's outperformance. But Singapore dollar is not immune to market developments. The higher for longer and US growth resilience are thematics that continue to underpin dollar strength, and it is not surprising that the Sing trades weaker against the dollar this year. The key focus for Sing will be the MAS policy decision in October. Recent CPI report shows that Singapore core CPI has further moderated, but headline CPI saw sequential uptick in August. This underscores the MAS's concern that both upside and downside risks to inflation remain, including fresh shocks to global commodity prices and a more persistent than expected tightness in the domestic labour market. Our base case is still for MAS to maintain policy status quo at the October meeting as inflation risks remain, and it may be premature to ease. For dollar Sing, the near-term risks are skewed to the upside, but looking out into our forecast horizon, we still expect a mild downward trajectory for dollar Sing, premised on our view for a moderate to soft dollar outlook on expectations that Fed is likely at the end of tightening cycle and to embark on rate cut cycle in 1Q 2024, as well as expectations that China growth to find a bottom in second half this year.